Hey there. Welcome back to Great Quarter, guys. This is episode 55. You can notice we have a bit of a different background today. Both Seth and I are recording from home, so excuse any minor bugs we may have moving forward. But glad to have you. We've got a fun show. We're going to get into a discussion about inventories and where we think they are going to head in 2021. We've seen a big disparity between retail import growth rates and retail sales growth. So we do think there's a correction happening. We'll talk about some notes from Craig Fuller and from Henry Byers, our maritime expert, on what they think inventories are going to do in the next year. And then we'll get into a little bit of retail expansion talk as well. But before that, let's bring Seth on. How are we, Seth?
Doing well, Andrew.
All right. So last week, I said that 2021 was off to a wild start. That was on the 5th. Lord knows that was an understatement. The 6th came. We had a crazy week after that. The same is happening in the retail industry and in the freight industry as well. Things have started off hot. We've got outbound tender volumes up 20% year over year on a rejection basis. We've got a good start to the freight market. So let's hop into you care or not, our gauntlet of interest. I'll give you a topic, event, or idea. You tell me you care or not about the idea and why. All right, so the first one is on Amazon. It has shut down its pantry program, which was most recently rebranded to Prime Pantry this was shut down last Wednesday. Prime Pantry was a monthly subscription service that allowed shoppers to bundle household goods for a flat fee. Seth, you care or not about Amazon shutting down Prime Pantry?
I don't care, and a lot of that is probably because I've never used it. We used Instacart in my house, and I think bottom line is Amazon is experimenting with their grocery offerings and trying to figure out sort of the optimal way to integrate Whole Foods and this new fresh concept, as well as their ghost stores. Although that being said, I do think they'll figure it out, but I actually think Instacart, which is going to IPO in 2021, and maybe even Walmart are doing a better job right now. What do you think, Andrew?
Yeah, I mean, I would say that Amazon's growing really fast. I didn't see Q3 numbers. I saw Q2 numbers for Amazon online groceries were up 300%. So they're growing fast, but you're right about them experimenting. This was one of their kind of earliest efforts to boost sales of packaged goods and food and beverage. And the whole order, it didn't make all that much sense. It was kind of like just a bridge to get Amazon to the point where they are now, where they can pretty much deliver any good at any cost at free for Prime membership or at a very low cost for non-Prime members. This pantry was basically as much stuff as you could fit in one box. You could get it delivered for a flat fee of $5.99. So you basically wanted to, you wanted to fill up that box with as much stuff as you can to spread that cost of delivery over all the items. Now they're just shifting all of that onto the Amazon website. The Amazon spokesperson basically said that pantry users can still order the same goods. They're not limited to a single box anymore. This, allows customers to get everyday household items faster without a subscription or a purchase requirement. So you're right. Amazon is experimenting. I do care about this one. I didn't say whether I do or not. I do care because I think that Amazon is already beginning to make its way and to be a dominant player in the grocery industry. It's taken them a long time to do this. They began kind of experimenting and debuting a online grocery delivery service back in 2007 in Seattle. So it's taken them a long time to get to Amazon Fresh, which is kind of their next leg of the grocery industry growth. It's taken them a long time to get here, but I do think they will become a dominant player like they have just about in everything else.
Yeah, I agree. I mean, I think they're going to make some good inroads, and why they originally made the Whole Foods acquisition. I mean, if you look at grocery, it's about $1 trillion category in the U.S. So every point of share is worth $10 billion. So can be a needle mover for Amazon, and not only that, but a lot of brick and mortar retailers, as you well know, have Walmarts and Targets of the world and Costco. They love that grocery business, even though it's low margin, because it drives those regular and repeat customer visits.
Right. Get them in the door where they can buy a lot of other higher gross margin items. So let's go on to our next one. This one is something I think we're going to hear a lot of this earnings season, as well as probably in the Q1 earnings season when that comes around at the end of March. But this is Bed Bath & Beyond. They missed analyst expectations for earnings per share by about half. I think EPS came in about 8 cents per share when analysts were expecting 20 cents per share. The company repeatedly pointed to shipping constraints and elevated freight costs as reasoning for the spoiled quarter. Seth, you care or not?
Care on this one for sure. I mean, it's very relevant to what we do. You know, I will say, you know, given how closely we follow these markets, I think there's probably something there. On the other hand, I've listened to hundreds or thousands of earnings calls and done this for a long time. And I do wonder, you know, to solely blame that quarter on freight might be a bit of a scapegoat. But I do think it, like, as you said, I believe in your your point of sale newsletter, I do think it'll be a common excuse. Particularly for anybody sort of on the packaged goods or retailer side, because as you well know, I mean, spot rates are up 40 or 50% year on year. And, you know, any one out of every four contracted loads is being rejected. So they're definitely paying more for freight. Tender lead times are extended, harder to get stuff. You know, even intermodal is incredibly tight. So I definitely think it's something there. Although, like I said, the skeptical side of me wonders, you know, there's a lot of moving pieces to this story. They've got a new CEO. They're closing down 20% of the store base. They're divesting they've got 4 or 5 concepts other than Bed Bath and Beyond. What you tend to see in these types of stories with all these one-time charge-offs and restructuring charges is a lot of times the executives will point to the easiest thing that they can scapegoat, and that sounds reasonable, right?
Yeah, I mean, it does sound reasonable. I mean, it certainly doesn't help that same store sales were down 17%, right? Or that foot traffic was dismal. Placer AI data shows them ranging between negative 40% and negative 20% pretty much all year since the stores reopened in June. You know, net sales were down 5%. E-com growth was really strong, up 75% year over year in the latest quarter. You know, like I said, I do think you should get used to hearing this because, so this is a quote from CEO Mark Triton. He says, "We know that freight pressure across retail is here to stay, and we've built that into our future plans." And he's completely right. You just mentioned it about the OTVI and OTRI. So here it is from Sonar. You know, you can see this growth that has exploded in July. It's just sustained this elevated bull market that we've had in freight. It's not going anywhere. Consumer demand is still pretty strong. Consumer sentiment is considerably high, and capacity is tight. Like you said, the outbound tender rejection index is north of 20, meaning that carriers are rejecting nearly 1 in 4 contracted loads, or contracted tenders rather. The market is very tight, and this pressure is here to stay. Mark Triton and the CFO said that shipping costs dragged their gross margin down by about 80 basis points in the most recent quarter. So I'll be really interested to see, you know, what other retailers are going to play this scapegoat card. It's certainly, you know, it could be a scapegoat card to get out of, oh, we couldn't attract enough people to our stores. You know, that's certainly possible.
Yeah, I mean, I will tell you, 80 basis points, that's material, especially when you're in restructuring and turnaround mode and you're already dealing with thin profit margins to begin with. That's certainly material. But I think you hit on a key line there. He said, we've built it into our future plans. So he's going to have a tougher time using that as an excuse going forward, unless spot rates, you know, 320 a mile, unless they continue going up, you know, and which I don't see personally. I don't think they're going to come down fast, but at the same time, I don't think we'll be able to maintain this slope, as I kind of talked about in Passport research this morning. I mean, I think it's the latest truck stop spot rates are 322, you know, including fuel. So that being said, we may have hit peak freight pressures in the first half of 2021, but it will be a common excuse.
Yeah, we'll touch a little bit about the capacity and just the freight market when we get into our conversation on inventories here in a sec. That definitely has to play into the other side of the inventories for the retailers. But before we get to that, we got a couple more of You Carrot with Nas. So this next one is about this new return policy that I'm seeing crop up from a bunch of different retailers. Actually, Walmart, Amazon, Chewy, and Target are all using AI to determine the financial feasibility of different return strategies. The newest one is just the keep it method. The items are typically low cost and non-repeat purchases, but basically you buy something from Amazon or buy something from Target, and it's so expensive for you to return it to them that they just refund you the money and say either keep it or donate it. What do you think of this strategy? Seth, you care or not about the keep it strategy?
I care, and I mean, it makes sense, right? Even on the smallest of package sizes, I know from looking at the average parcel rate with UPS or FedEx and in the post office, it's something like $8 or $9 or $10 even for Amazon. So if you're talking about an item with a purchase price of under $10, that makes absolutely no sense, both from an employee productivity and the amount of human capital that you need in the business, as well as we've already got enough capacity constraints in everything in freight across the board, not just truckload, but final mile and reverse logistics is booming. I think that Wall Street Journal article said returns were up 75% year over year in 2020. So, I think this makes economic sense, and you're going to start seeing a lot more of it.
Yeah, I agree. The first thing that came to mind was that, age old saying, if it makes money, it makes sense. This one's kind of, if it saves money, it makes sense. And the CEO of return software provider Narvar, who I do want to have on, Amit Sharma, he's a brilliant guy. He believes that we're going to see a lot more of this moving into the new year. His company provides software that can allow companies to better conduct returns. So, and he's seeing a big demand for this into the new year. So yeah, it really makes sense for no repeat transactions. And I really like the donate idea. So I read a story in one of those articles that a woman bought a pet harness that was too small, and Chewy just said donate it to the closest local dog shelter. So I thought that was great. I think more of those type of methods to get rid of the stuff rather than just letting it pile up in people's garage is better. Okay, so the next one is a bit interesting. So this one is on our favorite company to always talk about, which is Walmart. They're always making news. This next one, they are partnering with the Robinhood backer Ribbit Capital, excuse me. They're going to launch a fintech startup between the two, between Walmart and Ribbit Capital. Seth, you care or not about this partnership?
Yep, I care, and I think it's just one more instance, and I think you'd agree. Walmart is starting to show that they're kind of coming into the digital age and they're forward looking. You've had just so many of these. They've launched Walmart Plus. They've got the TikTok partnership. They've got Flipkart in India. You can really kind of go on and on, just from a digital era. And I think the partnership, whether or not it turns out to be massively successful, I like the strategic thinking behind it. With a lot of these financial services booming. I mean, you know as well as I do, Robinhood is booming. They're going to IPO. I think they signed up like between 10 and 20 million accounts last year, and Walmart has 160 million customers that at least once a week either visit the store or the website. So you can see that the cross-selling opportunity for Affirm and Credit Karma and Robinhood is massive. And not only that, but you really integrate yourselves into the daily lives of your customers, because a lot of these products, particularly Robinhood, most people are using on a daily basis.
Yeah, I love what you said. Walmart is coming to its age, into the age of digital. And they're doing that by doubling down on physical stores. We've heard this from Walmart execs that they are going to, continue leveraging their stores. That is their advantage over Amazon. And they're just doubling down on that. Here, there's always been, either a bank or the Money Center or Western Express or whatever, but Western Mutual, whatever money sending service that Walmart had in there. Now they're just going to cut that service out and fill it in themselves. I saw in that article that 6% of adults are unbanked currently, with 16% being underbanked. I'd say the chances of that population of people shopping at Walmart is pretty high. Just given Walmart's, spread of 4,700 stores across the country, a lot in rural areas or lower income areas. And honestly, for me, this is just about time. They're building themselves into this digital age of being a community center with banks and with, a doctor's office, a health center, and now, and also grocery and CPG and everything you could ever want to buy all in one place. It reminds me a lot. I've been doing a research, and I've talked to you about this offline, and that's FEMSA, which is a company in Mexico it owns one of the biggest Coca-Cola bottlers in the world. But they've very recently, in the last decade, been rolling out these convenience stores, and it's grown like weeds. It's called OXXO, OXXO. And these C-stores are basically the runway to the internet for a lot of Mexicans, a runway to e-commerce, because 60% of Mexicans are still unbanked. They have to go to OXXO to get their prepaid debit card so they can go and pay for their Netflix or pay for their Roblox or whatever they're going to pay online. But they have to go through OXXO to do it. I see that being kind of a similar trade-off here, with Walmart becoming the now digital payment wallet, the interface to the next two digital payments for these customers. They've already been that. Well, people have already trusted Walmart to handle their money for a long time, for decades. So millions of Americans have trusted them for decades. So I happen to see that this is a good move. They're just putting themselves in a better position to take advantage of stuff they were already doing and that people were already doing in Walmart's.
Yep, agreed. And I'm extremely. I think Walmart's making a lot of the right moves, and it's kind of a slow, sleepy stock, but I think it's going to wake up and just kind of explode one of these days. When right now, I think Walmart and Costco and Target. A lot of people in the markets are a little bit. There's kind of a rotation in the value and cyclical stocks, and people think that Walmart and Costco and all these places where people have been doing bulk up trips during COVID is that's going to decelerate after after the vaccines out there, and that's probably true to some degree. But I think they've also permanently won a lot of share here in COVID.
Yeah, agreed. I think some of that spending, obviously it naturally reverts back to some restaurant spending and less cooking in the home, but I do believe they've won over a lot of people this year. Okay, last one for you. This is on a potential merger. It won't be the first time they've tried this, but this is Staples attempting to buy Office Depot. Again, this marks the third attempt to merge the rival office supply superstores. Seth, you care or not about Staples trying to take over Office Depot again?
I don't care. No, but I mean, I understand why they're doing it. I think, I wish I knew the market share statistics off the top of my head, but clearly they're pretty confident that there's a lot of both either cost or revenue synergies out there in this deal, or else they wouldn't keep pursuing it. But I also think part of the reason they're pursuing it is because these are sort of secular declining businesses. Is I don't even know. I can't even imagine what's happening to the enterprise portion of the business right now. I would think that the PC side and some of the printer cartridges, but office supplies, given everybody's working from home, that business has to have taken a hit, I would imagine. So, maybe they're looking to tie things up because just that's the best path forward. When industries start to decline, the natural thing to do is to consolidate.
Yeah, if you want any data point to highlight the secular decline. So the last offer, which was made in 2016, $6.3 billion price tag. This one just over $2 billion. So just 5 years later. So the last one, I find this just funny, and it's not the only time this has happened. It's not going to be the only time. It will happen again. So the last time that these two tried to merge, it was shut down by the FTC, and the federal judge sided with the FTC and rejected the company's argument that Amazon's then nascent bulk office supplies unit would represent a major competitive threat. Boy, were they wrong about that.
Yeah, like, like I said, I'm not close to these businesses anymore, so I'm kind of speaking off the cuff here, but it seems that the competitive argument from an M&A perspective, it seems like just letting these two guys get together is not that big of a deal to me, at least intuitively.
Yeah, I agree, especially since Staples has said that apparently the last FTC sue, it was made because of the professional services, so kind of the in-house service companies within both Staples and Office Depot. Staples has said that they will sell whatever units necessary to make the deal go through. So I can't imagine this one being rejected at this point. Both these companies, kind of floundering and have been struggling for a long time. But excited to see if they go ahead.
No, I was just going to say, they can maybe in a couple of years they can try when they're $500 million market caps to merge again and get through.
Right. All right. So that wraps up You Care or Not. Let's move on to our main discussion of the afternoon. So it's on this chart that I pulled together. So this is data. The blue lines that you'll see on this chart are data from the Global Port Tracker. That is a combination between the National Retail Federation and Hackett Associates. So they basically cover and monitor retail imports. And you can see the first half of the year really slow, down huge. And the back half of the year, we saw this explosion of growth. So I'll give you a couple data points here. As of November data was up 24.5%. TEUs, retail TEUs up 24.5%, but down from October's 2.21 million TEUs, which also set the record for the largest number of containers being handled in a single month since they began tracking this in 2002. The December was projected at 2.02 TEUs, which would be up 17.3% year over year, and one of only 6 times in 20 years that the total monthly value has hit 2 million. If the December month holds, once the actual data is available, then 2020 will have ended with a total of 21.9 million TEUs, rather, which would be up 1.5% over 2019. So basically, the back half of the year, the explosive growth in the back half of the year, almost nearly completely wiped out the downfall, the trough in the front half of the year. See, that's what's interesting to me, Seth. I wanted to bring you in here. What do you think when you see that chart? What first comes to mind after you give your thoughts of what your initial thought was when you saw that? I'll give our CEO Craig Fuller's as well as Henry Byers, our maritime expert.
Yeah, I mean, so a couple things. The first thing that pops into my head is the dark blue line is more volatile than the green line, which means the imports and the TEUs are fluctuating more than retail sales are. So in the first half of that chart, the blue bars are down a lot more, and then they're up a lot more. So what happened was, as COVID-19 spread in the spring of last 2020, you've got this destocking element because demand is going down, unemployment's rising, retail sales are falling, and you just have this exaggerated effect. And now we're playing catch up where the retail imports are now outpacing the retail sales. And then we can get in and talk more about it, but there's still a lot of catching up to do just in terms of that inventory to sales ratio. But I kind of talked about this last week on our podcast when we were talking about Deutsche Bank's outlook for the 2021 and transportation markets. And, particularly in industries like transportation and cyclical industries, you get this double bang going in and out of a recession. So you get hit twice as hard when you're going into a recession because of the destocking, and then you get twice as much benefit because you get a rebound in retail sales, and you get that normalization in the inventory to sales ratio. And what's interesting is transportation normally, I think, would have gotten hammered in a recession. That's what we saw in some previous ones, but given the fact that everybody's stuck at home and that goods to services mix shift benefited transportation.
Yeah, I agree with that. I wish I would have seen that chart. I wish I would have made that chart prior to our last episode. I don't think I would have disagreed so much with Amit's thesis on pent-up goods demand if I had seen that and seen that there is still, I think, quite a bit of restocking to do. They're still months behind. We've seen that there's still 15 or 20 ships awaiting, a spot in the port of LA. So we've got these weeks worth of freight that's still coming in, and I was kind of expecting that to make headway, to get closer to catching up to retail sales, but. Let me give you the thoughts of Craig Fuller, our CEO. He sides with Amit on this. He said, watch the fireworks when I asked him what came to mind when he saw the chart. He is bulled up on both consumer and corporate balance sheet health. So I believe corporate balance sheets are as flush with cash as they've ever been. Also, the U.S. savings rate is about double the 5-year average, currently sitting at about 13%. So consumers have a pretty healthy war chest to go and spend money. He believes there's still a lot of pent-up demand. And now with the certainty in Washington and an accommodating Federal Reserve, he believes watch the fireworks. And then Henry Byers basically alluded to the same thing that you alluded to, which is an inventory buildup, kind of a correction here in the first couple of months of the year. But all that will depend on where demand goes, right? I mean, where can we expect consumer demand to go? I think we both expect it to be high. And what are your expectations for when we see inventories catch up and start making headway and we see a correction in that inventory to sales ratio?
I mean, forecasting stuff like the inventory to sales ratio is really hard. I mean, we have a graph here at some point that we can put up here to kind of show, but basically there it is. This inventory to sales, it's basically varied. This is going back 10 years. And this is from Credit Suisse's 2021 railroads outlook. And basically over the last decade, it's gone between 1.2 and 1.3 times, kind of averaging 1.25. But what you saw last year was such an extreme year that it blew way out to 1.35 in April when demand collapsed. And then as demand recovered here, it blew all the way down to 1.1. And this is from FactSet, and this is excluding automotive. But you can tell here right now we're still inching along the bottom, and we're kind of coming back up. So just to get back to that average, it depends on what you assume. If you assume we just get back to average, then you probably got still a meaningful amount of time to close that, to go from 1.1 to 1.25. Now, if you go back to the prior peak, then that probably gives you more like a year or a year and a half or 2 years. And a lot of that depends on your outlook for consumer sales. I agree with you. I think given the depth and the Keynesian response that we saw in this recession to offset the massive drop in demand for services, I don't think, and given an easy Fed, and I'm far less worried about the economy. I think we're years away from another recession, presuming that these vaccines are actually, we can get them out there and vaccinate people, and they'll actually take a vaccine and achieve herd immunity. But presuming all that happens, I'm very bullish on the economy, not only in 2021, but 2022 and maybe even 2023, because that's how long it's going to take you to catch up to get back to pre-COVID levels. I'm more worried about honestly the debt situation and the currency type situation of all this crazy spending that is going off from a stimulative effect. But the long-winded answer to your question, I think we've got at least 6 months, if I had to guess, maybe a year and a half in the bull case.
Yeah, I think it'd be beneficial if I tossed a couple of the NRF and Hackett Associates expectations for the first few months of the year. So they've projected through May their retail import expectations. So for January, they're expecting up 7.7% from a year ago, which would be the busiest January on record. They're expecting another big month in February, up about 6%. And then this is where it really starts to grow, which is in March, April, and May. So you can remember back to March 2020, Lunar New Year happened in China, and then those factories were never able to ramp back up. They were never able to open back up. So we had this kind of glut, or this lack of imports come through. So pretty easy comps beginning in March. And so they're expecting up about 20%, up 19% in March. And then again in April, up about 10%. And then another huge growth expected in May, up over 20%. So imports are going to continue flowing. Like I said, 15 to 20 ships awaiting port spot now. There's going to be dozens following that. Retailers are, still trying to get back to a level of inventory that's even respectable. I mean, we saw empty shelves over Black Friday. We saw empty shelves over Christmas. Even especially these stores that have pivoted and are using their stores as DC centers and fulfilling online orders, they're strapped for inventory. So I agree, it'll take some time to build them back up. We've got a lot of freight on the way. Definitely will keep the freight market booming for the next few months. You want to talk about capacity? I think we've got 2 minutes here. We can talk quickly. We touched on it a second ago on what we thought new truck orders and what all this equipment meant. I don't know if you read Zach's chart of the week over the weekend, but he talked about when is all this capacity going to hit. Do you have any thoughts?
I did. I read Zach's chart of the week, which people should check out on Saturday. Basically, the gist of his chart of the week is truck orders are booming. And I've talked a lot about this in Passport Research and on this podcast and elsewhere. But you're gonna take these truck orders are 2.5 times replacement rate, running up between 150 and 200% year on year for the last few months. However, you're having trouble seating these trucks. And if you look at the overall trucking employment from the BLS, it's still down 500,000 jobs from either, I don't remember if it's pre-COVID times or on year and year. But in any event, given the growth in freight demand since that time, you would need you need to get back to 2019 peak capacity to really start to tip the balance back the other way in terms of rates and and capacity swamping demand. That's kind of my view. I think trying to do some sort of scientific estimate on this is nearly impossible, and there's no great ways to even track capacity. Not even we can do it yet at FreightWaves. So it's kind of a little bit of a guessing game. But again, I think at least 6 months. When you start to see those headwinds back to services, because I'm a big believer that that services demand is just going to absolutely explode. So I'm a little bit, I wouldn't say bearish, but just cautious in the back half.
Yeah, as am I. Got a generational release of pent-up demand for services coming soon. Excited for it. I'm excited to be one of them out there spending money on services. That's all we got today. Thanks for your time, Seth. You can find all of our shows on demand on FreightWaves TV or your favorite podcast player. Simply subscribe to FreightCast to get every single FreightWaves podcast all in one feed. Thank you, guys. We'll see you again next week, 3 o'clock.